It is my privilege to introduce Patrick Bolton, the 74th president of the American Finance Association. In preparing my remarks, I did basically what everybody here would do, go to the Vita. And although I'm often very critical of my colleagues for doing the counting, something jumped out at me that was remarkable. Patrick Bolton has 23 A-level publications, and that does not include any of the top 3 journals in finance. Wow. So Patrick is a very serious scholar, and indeed, he's a very serious person, which makes my job incredibly difficult. If I had Luigi, it would have been a lot easier. So this was way more research than I ever imagined. So I did get a tip, and let me read this email. He, Patrick, and Philippe Aguillon, then a PhD student at Harvard, were inseparable. They laughed a lot, but no one knew what they were laughing about because the jokes were always in French. Patrick was very serious in English. Okay, so basically the idea here is that Patrick is very serious in English, but in French, he's a party animal. So doing a little investigation and learned to use google.fr rather than google.com, I find that Patrick's had a secret interest in stand-up comedy. So it's very surprising. There he is outside his favorite club in Paris, inside the club, and actually kind of looks like Luigi in the background on the stage. Okay, well, Patrick, very versatile, and maybe actually wanted to try his hand. And there he is at Blue Comedy Club. And didn't go so well. I think the clothing was a factor. But Patrick really worked on his act, and you can see that he finally focused on that famous Wharton graduate. The French love it. And eventually, a new set of clothing. So this is all Photoshopped, of course. But let me be serious. Look, all of us know Patrick's work in terms of contract theory. This is really a big deal. His research focuses on the allocation of control and decision rights to contracting parties. Wish I could get rid of this. When contracts are incomplete. This is important for many different applications: optimal debt structure, corporate governance, and the firm's optimal ownership structure, vertical integration, and even constitutional design. And this is just a glimpse of what he has done in his career. If you tour his research portfolio, you'll see a combination of contract theory, game theory, and information economics applied to a wide variety of topics, ranging from capital structure, executive compensation, banking, the economics of development, sovereign debt, and experimentation in economics. Instead of reviewing his body of work, which is frankly impossible given the allotment of time at this meeting, I'd like to walk you down his research path. He's moved around a lot in his career, not only physically, but also intellectually. He was trained as a PhD. His PhD was from LSE, and he's trained by contract theorist Oliver Hart, the new AFA fellow, in the mid-1980s. After graduation, he spent time in the economics departments at Berkeley and then to Harvard. In this period, he developed a series of path-breaking papers with Philippe Aghion on incomplete contracts and with David Sharfstein on industrial organization and financial contracting. He then moved back to Europe in the early 1990s, where he had the extraordinary title of Chargé de Research at l'École Polytechnique in Paris. He also worked at Free University in Brussels and the London School of Economics, each for a few years. During this period, he expanded his research by using conceptual insights from industrial organization and contract theory to tackle important issues in the theory of the firm and the economics of development. Perhaps his biggest idea is that the allocation of control rights is important in financial contracting. That is, a better allocation of control rights leads to more efficiently designed contracts and, in turn, to larger economic surplus or welfare. The standard view was that financial contracting was mainly about the allocation of cash flow rights. He changed that view. This idea comes up most prominently in his best-cited paper, An Incomplete Contracts Approach to Financial Contracting, published in the R.E. Stud in 1992 with Philippe Aghion. After Patrick moved to Princeton's economics department in 1998, he continued his work in corporate finance and furthered it by adding law and finance to his portfolio. During his stay at Princeton, he wrote a series of influential papers covering many important corporate finance issues, including corporate governance, executive compensation, and capital structure. He also, during this time, finished writing his co-authored book, Contract Theory, which is widely regarded as a landmark and a standard reference in this important field. After he moved to Columbia GSB in 2005, he firmly established himself as a leader in corporate finance theory and served as managing editor of several leading journals, including R.E. Stud and Econometrica. In addition, after the financial crisis, Patrick turned to a host of issues to help inform policymakers, such as credit ratings, bankruptcy protection for derivatives, compensation, and rents in the financial system. From this impressive and highly unusual path, Patrick is remarkably broad. He has interesting and unique insights about pretty much everything in finance and economics. The style of theory work that he does is, to me, amazingly versatile. So on one end, he has published a hardcore continuous time model of two-armed bandit problems. On the other, he publishes a 100-page paper in a law journal without a single equation. While Patrick has moved around a lot, he leaves a unique and lasting impact everywhere. Here is an example of that impact. This is an email I received from a junior colleague. As an assistant professor, I was very fortunate to have Patrick as a senior colleague, a co-author, and more importantly, a mentor, even to date. He's extremely friendly and a great listener. In particular, he was willing to listen to a junior colleague about random thoughts for a long time before providing his feedback, always in his encouraging and constructive way. To conclude, let me make some remarks on my own experience with Patrick as leader of the AFA. In the past, the AFA job has mainly been about running a 90-minute board meeting once a year and running this annual general meeting. During Patrick's tenure, a lot has happened. We now have multiple board meetings per year. We have 4 standing committees of the board. Previously, we had 0. We have an investment committee, we have the academic female finance committee, the ethics committee, and a new editorial committee. Patrick also chaired the ad hoc search committee for the new editor of the Journal of Finance. We have new guidelines for the nominating committee, as well as new procedures for granting prizes. We have a conflict of interest policy. While many were involved with these initiatives, Patrick was the leader, devoting his time and energy. I certainly learned a lot by serving with him. In short, Patrick is a dedicated member of our field and a thought leader. Colleagues, it is my pleasure to introduce the President of the American Finance Association, Patrick Bolton.
Cam, thank you for these very kind and embarrassing words. And I wish my French persona that you described was true. Before I launch into my address, I would like to acknowledge some important debts. As you've already heard from Oliver, my biggest debt is to Oliver Hart. Oliver was my undergraduate supervisor in Cambridge, England, at Churchill College. Now, many of you may not know what that means. As an undergraduate, you meet with your supervisor, either one person, one student or two students at a time for 1 hour, and you go through the essay that you've written and handed over the night before. I'm sure Oliver remembers this very fondly. It had an enormous, of course, incredible impact on me. I was incredibly fortunate. Later, Oliver was my PhD thesis advisor, and I was also fortunate to have Jean Tirole and Eric Maskin as my advisors. Both of them who I met at Churchill College, Cambridge. So I owe a very special debt to Churchill College. And of course, I owe enormous debt to my co-authors, my students, and I also want to thank those of you who have voted for me and allowed me to be here and speak today. I have to say it's an incredible honor to be representing the AFA this year. You already showed me with a photograph with a Donald Trump hat, so I was going to, I'm not going to add another Donald Trumpism, but it is an incredible honor to represent such an incredible association. Okay, so some of you may have wondered what the title is about. So before I launch into the key topic, I want to frame what I'm trying to do, and that is, we all know finance has taken a beating lately. The financial services industry has lost its luster with the public at large. We've heard that from Luigi Zingales' presidential address last year. But it's not just that, it's also that some important recent empirical work has cast some doubt on the validity of classic corporate finance theory. I singled out two important studies here. The first one by Lemon, Roberts, and Zender, and let me quickly read you what, the big takeaway of the big conclusion of their paper. So they adjusted R-squares from traditional leverage regressions using previously identified determinants range from 18 to 29%. In contrast, the adjusted R-square from a regression of leverage on firm fixed effects is 60%. And then they conclude that the cross-sectional variation is largely unexplained by previously identified determinants. And then this year, D'Angelo and Roll made a further observation, which makes the task even harder. and that is that leverage cross-sections more than a few years apart differ markedly. And you might draw the conclusion from this that, wow, there's all this research, theoretical research on corporate finance, but what have we learned from it? Now, I accept that some of this criticism is warranted, but I want to say that we should be careful not to throw away the baby with the bathwater. From my point of view, what corporate finance theory brings is an understanding of financial constraints and how financial constraints for corporations shape corporate investment and financial decisions, but more generally, how financial constraints affect decisions. And this is a topic, viewed from that point of view, it's an expertise we build that can be applied to firms, can be applied to households, can be applied to banks, and the topic of today's address is that I want to apply this expertise, this corporate finance perspective, as I name it, to sovereign finance. Now you'll pretty soon begin to understand how the title falls into place. So I will build my discussion around a companion paper with my co-author Haizhou Huang, previous research on sovereign debt restructuring, and related literature in international finance. So we all understand the analogy one can make between countries and corporations. We heard about Japan Inc., Switzerland Inc., and so on. So that's easy to understand. But if you take that and ask the next question, which is, okay, if a country is a corporation, what's the analog for a country of a corporation's capital structure? Then you have to pause for a second. In particular, you have to ask, next question that comes up is, what stands for equity for a country? And so the bold idea I want to propose, it's an imperfect analogy, but I think if you make it and you push it, you gain a lot of insights. So the analogy I want to push is that what stands for equity for a corporation is fiat money for a country, or money-like claims of that country. So if you want, shares in a company entitle the owner to a pro rata share of output. Well, in a way, for a nation, you have the same idea. The money entitles you to a share of what the country produces, goods and services, net of debt obligations, of course. And if you think about domestic currency debt, the closest analogy is a pay-in-kind security for a corporation. And we know that pay-in-kind securities are treated as close substitutes for equity. What's the point of making such an analogy? So what do we learn from this? Basically, what we learn is that, the point of this is that we can apply traditional corporate finance trade-offs to sovereign finance. In particular, notions of debt overhang, cost of default, and dilution costs. And here I'm going to draw an analogy between dilution costs for equity, for shareholders, and inflation costs for a nation. If you want, dilution for fiat money it's the debasement of the currency. Debasement of the currency is another word for inflation. And once you make that analogy, you can develop a theory of the optimal financial structure of a nation that pits inflation costs against default and debt overhang costs. And so the contribution of the theory is to make this explicit. So I will return on that in a few slides, but if you want, the immediate implication of this is that you can have a little bit more to say about how money enters the economy. It's not dropped from a helicopter. Money enters the economy through purchases of real goods and services. That's the first point. Another point, which I will come back to, is that taking a leaf off Myers and Maslow and the notion of dilution, dilution cost is a form of redistribution cost. It's you're transferring wealth from existing, from, if you want, old shareholders to new shareholders. Same thing with inflation. Inflation cost is a redistribution cost. There is no inflation cost without redistribution, at least in the model that I'm developing. So let me outline, maybe take 10 minutes to outline the model so you have a better feel of how to approach this, and then I will turn to the implications. So model is a pretty standard small open economy model over 3 periods. Date 0 is the investment period, and I'm going to think of this as an infrastructure investment, which I'll denote by K. Date 1 is the production period, which involves allocating an endowment between consumption and production. The endowment is denoted W, consumption C1, and production X. And then day 2 is when output is realized and consumed. So in this small open economy, we have a representative consumer. This is the utility function of the representative consumer, and all you want to take away here is it's risk neutral, and there's a preference for late consumption over early consumption. We also have a representative competitive firm, and here what you want to take away is that there is uncertainty in output. That's the productivity shock theta. Output is higher the more inputs you're using, X. And then if you're undertaking more infrastructure investment, K, that makes you more productive, and so you have this coefficient, Q of K, that reflects the better productivity of your firms. So the way things play out, so let's move to date 1 and date 2, and then I'll revert back to date 0. Date 1, you have trading happening, you have firms buying inputs from consumers, and firms use their stock of money, endowment, M, and consumers sell their endowment, W, to firms. Then firms produce, then you come to the second period, firms then sell their output against money that is now in the hands of households. Of course, you might wonder, well, what's the point of getting money back for firms? Well, you can think of this as being just a slice over time, and that this money will help the firm buy more inputs in the future, and that's why it's valuable. So that's how you maintain the value of value of money in this simple model. So a representative consumer will maximize this objective function, will decide how much to provide as inputs in period 0 to the firm, how much to consume. And the way the model is set up, it's very simple. You prefer to sell all your inputs to the firm in period 1. So period 1 is an investment period if you want. Period 2 is a consumption period. You can tie down the price. This is a monetary economy. You can tie down the price of inputs. Period 1 is just the money stock divided by the stock of inputs. And then you can determine the price level in period 2, which now depends on the productivity shock theta, and is again just given by the ratio of the money stock in period 2 divided by total output. And notice this is a model where you have a classical quantity theory of money that holds. Now in this model, if you revert back to period 0 and you look at the investment, you can derive a Modigliani-Miller theorem for nations. That is, if there are no frictions. I will introduce frictions in a second. So what I mean here by no frictions is the country can commit not to default on the debt, and the country can commit not to inflate after it has used money to buy the investment. And so you can derive a Modigliani-Miller theorem. And then moving to the next step, you can introduce frictions. And here I'm introducing, a very classical friction in international finance, which is the willingness to repay problem. And the novel part of the analysis is the willingness to inflate part, where I'm taking a leaf of Myers and Maslow and later work and modeling dilution in the form of inflation. So we're going to look at a country that has can issue money at date zero to buy the inputs necessary for infrastructure investment from foreign investors. But then foreign investors don't know going forward whether their claims are going to be diluted by a monetary dove government or whether they'll be lucky to face a monetary hawk government. Okay, so we're modeling things very simply. Monetary dove government expands money supply at date one and basically hands over more money to domestic residents, which dilutes the claims held by international investors. A monetary hawk government will commit not to do that. Domestic residents have beliefs about whether they're going to get a monetary government, a monetary dove government, or a hawk. Those beliefs are represented by lambda. We're allowing for differences of beliefs between investors, international investors, and domestic residents. International investors have beliefs mu, so mu is the probability that an international investor assigns to facing a monetary dove government in period one. I will just give you the treatment of the model where beliefs are not updated by foreign investors, so mu remains a constant. So here's how it basically works out on the inflation part. So if following a money issuance at date zero of delta 0 minus 1 times m to pay for the infrastructure investment, subsequently a monetary dove government expands money supply further, then you end up in period two with total money stock of m times delta 0 times delta 1. So that's a bigger money stock, and you divide that by total output. That gives you a price level p hat 2. In contrast, if you have a monetary dove government, a monetary hawk government, money supply is not expanded, money stock remains at m times delta 0, you divide that by output. Okay, so then if you're an international investor, you're offering K, infrastructure investment at date 0 to the country. You'd like to get K back in expectation at time 2. You're putting belief mu that you're facing a monetary dove government later, and so you're dividing by the expected price level under that scenario. And that gives you, you can see the equation there, that basically gives you if you want, the participation constraint for foreign investors. Now, from the point of view of domestic residents, they are looking at this increment in stock of money, delta 0 minus 1 times m, using their own beliefs, lambda. So from their point of view, if mu is bigger than lambda, they are perceiving a debasement cost from the increase in money supply, and that's the expression for the cost. That's for the inflation side. Now, the willingness to repay problem is easier. That's a more standard thing. I'll just focus on the inequality there that you see at the bottom of the slide. So what you see on the left-hand side is what the consumption would be for a representative resident after servicing the foreign currency debt. And what you see on the right-hand side is what the consumption would be if you choose to default and incur a default cost, which is proportional to total output. So of course, what that gives you is you're going to have a cutoff, theta d. If theta is less than theta d, you want to default. If theta is bigger than theta d, you want to service the debt. And then you get an expected deadweight cost of default, which is expression given at the bottom of the slide here. So just to, just not to give you too much detail, what this all boils down to, you can now put all the pieces together and get a simple trade-off. So the only thing I need you still volunteer here is I'm going to make a comparison of 100% debt financing versus 100% equity financing. The paper, of course, does a more general characterization. And here I'm just going to give you the expressions for the special case where there are two productivity shocks, a low one, a crisis shock, and a high one, a normal time shock. And the probability of a high productivity shock is pi. Okay, so under debt financing, risky debt financing, the expected deadweight cost is given here, 1 minus pi, theta L, phi, omega. So then you put everything together and you get a simple condition when you prefer equity financing, when you prefer foreign currency debt financing. And then you can play around with the changes in parameters and derive implication. I'm going to mention 4 implications. Some are, you can say some very specific, so just purely model-driven. Things like, for example, if the country has an undeserved reputation as being prone to inflation, of course that country will pay a huge cost financing its investments with domestic currency. That might be the case for emerging market countries, countries like Argentina, who, deservedly or not, may have a high reputation for inflation. Vice versa, rich countries that have high output, even in crisis times, but would face very high default costs, such countries maybe should stay away from excessive foreign currency debt financing. And then emerging market countries, poor countries that have very low output when they are going through tough times, well, they're not going to lose that much more if they default. So they might actually prefer foreign currency debt financing. It would be a form of GDP index debt. Second implication, which is a more general one, is to monetary theory. Basically, this simple framework tells you that the optimal quantity of money in the model with frictions, it depends on a subtle trade-off between inflation and expected default cost. In other words, there is no simple rule for the evolution of the optimal quantity of money in an economy with frictions. As Baker and Wergler have argued for corporate leverage, a country's optimal quantity of money and currency composition of its debt can be understood as a history-dependent outcome of a succession of evolving trade-offs. Let me push this implication a little bit further by talking about what that means for the management of foreign currency reserves by countries. One of the most vexing questions that the international finance literature that's focused on this had to face is determine what the opportunity cost is of building and holding reserves. Now, there is a growing literature there. There's some of the analysis is quite technical, discussion is quite technical. I thought I would give you the summary or the upshot of all this by giving you a quote of Larry Summers. In fact, the quote is 2 separate quotes, but on the same discussion of the paper by Olivier Jeanne. So first he points out and says, in a perfect capital market where all assets are perfect substitutes and reserves are financed by issuing domestic debt, holding reserves costs nothing at all. That's Modigliani Miller. Then he goes on, I think very interestingly, and talks about his personal experience. Soon after I arrived at the Treasury, I was briefed about the Exchange Stabilization Fund. One of the first questions I asked was why this fund was the size that it was. Greenspan reported to me somewhat sheepishly that their conclusion was that the optimal level was somewhere between 20 billion and 2 trillion. Now, if you apply our framework, you say the marginal cost of building reserves is the dilution cost associated with printing more money. Now, this cost may be small for some countries, especially in the current context, and possibly even negative. This is the case for countries with low inflation or possibly even deflation expectations. Let me give you 2 prominent examples, Japan and Switzerland. Japan increased its foreign exchange reserves from 7% of GDP in 2000 to 26%. Over this period, Japan had no inflation. If anything, had deflation. Switzerland is even more striking. 10% of GDP was reserves in 2007, 100% today. Switzerland inflation also didn't rise. In fact, it's going down. Switzerland is even today in deflation territory. This is just in more detail the evolution of how Japan built up reserves. And what you see here is that, Japan has had large current account surpluses, but Japan went out of its way not to cancel those current account surpluses with a capital account deficit. Every single year it's built up reserves. And for Switzerland, it's even more striking. Switzerland did, up to the crisis, basically manage to try to keep the reserves constant. And then with the crisis, it let reserves accumulate and basically managed to accumulate foreign assets worth 100% of GDP for free. Fourth implication, I'm told I only have 10 minutes, so I can go faster. So fourth implication, I think an important observation regarding European monetary union. By separating fiscal and monetary policy and entrusting the conduct of monetary policy to an independent supranational central bank, the European monetary union, this was an unintended consequence, converted domestic currency debt of the member states into foreign currency debt. Monetary union shut down the possibility of funding investments or building foreign exchange reserves through money issuance. And you go back to the analogy to corporations, as if a corporation put in its bylaws that no new equity issuance is possible. So this brings me now to the last topic I want to touch on briefly. In the interest of time, I will have to go rather quickly, but that's sovereign debt restructuring. The first point I want to make is that when you look at countries that have defaulted, Argentina, countries that are about to default, like Greece, the costs these countries incurred are astronomical. And I'm asking the rhetorical question, is this a necessary and inevitable byproduct of well-functioning sovereign debt markets? And of course I will argue no. We need to think of better ways of limiting the costs associated with financial distress, excessive buildup of debts for countries. Give a little bit of a historical background. That was certainly the presumption by those who set up the IMF. The IMF was charged avoiding such debt crisis, making sure countries did not default and pay these huge costs, and basically helping countries overcome crisis through bailouts. That's a system that's went on for a while, worked for a while, but it reached its limits with Russia, the Russian default in 1998 and Argentina 2001. Basic limit of this system, moral hazard. When Russia was let go, this was after 4 bailout packages in succession every 2 years that the IMF did. At some point, the IMF decided, well, then we can't go on forever. So then the regime started slowly changing. We have to allow for default. Can't have just bailouts. And then the IMF went into a major research initiative, decide, well, how do we change the rules given that this default has to happen? And this is when the IMF launched the proposal of essentially the bankruptcy procedure for sovereigns, which it was called the sovereign debt restructuring mechanism. The idea here was countries are not that different from corporations. Country debt crises are not that different from corporate debt crises. Now we've learned over a century how to make it less painful, more efficient to restructure debts for corporations. Let's take a leaf of that and apply to countries. So let's have a bankruptcy procedure for countries, and let's have the main ingredients. Stay on debt servicing, stay on private litigation actions, a haircut approved by supermajority of creditors, debtor in possession financing during the restructuring, and importantly, at least when you do the analogy with Chapter 11 in the US, also debtor in possession, that the administration that is undergoing bankruptcy remains in place. The SDRM proposal was abandoned in 2003 due to lack of political support. And the only, if you want, a small change that happened is the introduction, the push towards the adoption of collective action clauses in sovereign debt contracts. That's been progress, no doubt. Collective action clauses do facilitate bond restructuring, but what we've learned in the last 2 or 3 years is that one thing they don't do is prevent litigation. And there's been an incredible development the last 2 or 3 years on the litigation front. And that's been the litigation between the holdout hedge funds holding Argentine debt, the Argentine government having defaulted in 2001. These holdouts refused to restructure this debt in 2005, and they've been litigating ever since to try and collect in full. The amazing thing is the court ruling in 2012, Southern District of New York, changes the game completely, because it's not just that the court says the litigants, the hedge funds, have a claim. The court says you're not allowed, or it says to Argentina, you're not allowed to service your other debt claims if you don't service the holdout claims. This has basically forced Argentina to default on its restructured debt in 2005. And the situation today is that nobody knows what the legal status is of sovereign debt. Nobody knows whether the debt that they're holding is such that the country will, under all circumstances, be able to service it. There won't be similar actions blocking a country from servicing this debt. So that's been a major development. The other important development is the Eurozone debt crisis. An important agreement was reached, an informal agreement, between Angela Merkel and Nicolas Sarkozy in October 19, 2010 in Deauville. What did they agree? They said, well, we can't have all these member countries in the Eurozone build up lots of debt and being bailed out. That's moral hazard. We have to introduce some discipline. We have to make funding of the European Stability Mechanism conditional on a partial bail-in. That was the agreement. And immediately when this agreement was announced, after Deauville, central bankers started getting very upset. Now, of course, what happened a few months later was a full-blown Eurozone debt crisis. And a lot of people blamed this Deauville agreement for the debt. They thought the cause was the Deauville agreement, because the holders of Greek debt, Portuguese debt, Spanish debt, they were now being told after Deauville there could be a bail-in. Now, when Mario Draghi joined the ECB, the priority was to save the euro, extinguish the spreads, the rising spreads in periphery debt. And so it was whatever it takes. And whatever it takes replaced bail-in. Now, you cannot talk about bail-in anymore in Europe, at least for sovereign debt. It's all debt overhang. That's the foreseeable future for the Eurozone debt. Now, one thing we've learned, though, from the Eurozone crisis is that, and especially last summer in Greece, it made this very clear, that a major difficulty with sovereign debt restructuring is that it puts the banking system at risk. And when you're close to the cliff, as we saw last summer for Greece, you have the choice of a collapsed banking system and mayhem for months or years to come, or you pull out all the stops and you service your debt while you pull away from the cliff. That's understandable. That's what the Greek government did. So that's a major obstacle to sovereign debt restructuring. I mention that because I think that the analogy corporate bankruptcy, sovereign debt restructuring is imperfect. some of it is definitely valid, but I think a better analogy, or an additional analogy, which is also relevant, is sovereign debt restructuring and bank resolution, and in particular, systemically important financial institution resolution. Now, the new model for the resolution of systemically important financial institutions is to make sure that you require the SIFIs, systemically important financial institutions, to hold a lot of long-term debt at the holding company level, and when losses accumulate in some of the operating affiliates, you force a bail-in of the long-term debt held at the holding company level to make up for the losses. But you don't touch the operating affiliates. You let them open for business on a day-to-day basis. That, I think, is also possible for sovereign debt. You could have two classes of debt. You can have a bail-inable debt that cannot be held in the banking system. And, of course, it has to be subject to regulation, to rules, and non-bail-inable debt, which then allows you to keep the banking system functioning, open for business. Okay, so let me conclude, and I hope I sort of given enough hints to suggest that much can be learned from an analogy of sovereign finance and corporate finance. Now, an early arbitrage between the two fields was around the notion of debt overhang. After Stu wrote his 1977 paper, Jeff Sachs and Paul Krugman applied the idea to emerging market or poor, heavily indebted poor countries, the HIPC countries, and that was the intellectual underpinning for the debt relief initiative of HIPC countries in 1996. Now, I hope I've made it sufficiently convincing that the parallel between corporate equity and fiat money or money-like claims allows you to complete the arbitrage. You do it on the debt side, you do it on the equity side. Of course, many caveats remain. Those are discussed in a fair amount of detail in the presidential address, which you'll find posted on my website. I don't have time to go into those, but I hope that I've convinced you that this may open up many questions for future research. In particular, the only one I'm volunteering, what are the governance implications of debt relief?
Thank you very much, Patrick. There's a few extra things for you. The first is the traditional plaque certifying you're president of the AFA. Congratulations. And second, you are now a fellow of the AFA. And there you go. Thank you very much.
I think there's one last thing I need to do, right?
Yes.
Which is I have to hand over the symbolic gavel to Cam, who will be the next president.
Okay.
Thank you, Cam.
Thank you. So before I actually use the gavel, I want to remind you that we have a reception next door that probably already is going on. So I see some of you. So we will reconvene the AFA in Chicago in January 2017. I declare the meeting adjourned.